In this chapter, we talk about pension plans. And if you understand the concept of all of these words or the definitions of them, it's going to be really helpful when we start getting into the calculations and the journals. So we're going to spend some time going through what each of these words mean and how they impact the pension plan. The first thing to understand is the difference between the kinds of pension plans that are offered. We have a defined contribution plan. In this plan, the employer, or ER, I'm going to abbreviate throughout just to make sure we save some space and time. The employer agrees to contribute a sum each period. This amount can be based on a variety of different things. It's usually a very simple formula. Some factors that go into it might be age or length of service. It could be based on the profits of the company. Sometimes it's just a matching amount to what you contribute in a defined contribution plan. But it's usually pretty simple, straightforward. As long as the contribution is made every year, there's no pension asset or liability reported on your balance sheet. In comparison to a defined benefit plan, a defined benefit plan is based on what the benefit the employee will receive when they retire. It's based on what the employee, we're going to abbreviate that EE, will receive when they retire. Now this is much more complex. Benefits are, defined in terms of uncertain future variables, such as when that employee is going to retire, how many years of service they're going to have at that point, what is their salary at that point. Plus, the employer is putting money into this plan, what kind of rates of return are they getting? Because this is so complex, usually the calculations for what an employer has to contribute is going to be done by actuaries. They're going to come up with your obligation, how much you should be contributing each year to make sure, based on all these variables, that the plan is funded. So let's talk about some of these other terms you're going to see. The projected benefit obligation, what this is it measures the obligation, or what an employer has to contribute based on the computation of both vested and non-vested service using future salaries. And let's talk about vested versus non-vested for a second. Lost my train of thought there for a second. So when you started a company, typically you are non-vested, meaning employers don't want to contribute on your behalf if you're going to be leaving the company within a certain time frame. So non-vested means that you're numbers, your salary, your age, all of that go into the formula for how much obligation the employer has. But it's not until you are vested that you're actually going to be able to receive these contributions when you retire. So non-vested is that first portion of your service where there's a little bit more chance that the employer does not have to pay on your behalf because you might leave the company. Vested means they're going to have to pay. So these calculations are a little bit different. A pension asset means that your pension is currently overfunded. And hopefully by now you kind of see that this is very complex. There's a lot that goes into this. So we will have a pension asset or a pension liability on these defined benefit plans because there are so many variables. So a pension asset, again, means a pension is overfunded. We can determine if it's over or underfunded based on the fair value of the asset of the plan. So your fair value of the plan's asset is greater than your projected benefit obligation, or PBO. So your projected benefit obligation, again, we're going to use some abbreviations, PBO. This is in comparison to your pension liability. You have a liability if your pension is underfunded. And all that this means is that your fair value of your plan assets is less than your projected benefit obligation. So your fair value of plan assets again is now less than your projected benefit obligation. It's a lot to take in. That gives you a little foundation. But the next thing we're going to talk about is our pension expense. Again, a lot of terms and variables go into our pension expense. So we want to make sure we understand those. Your service cost is the expense caused by the increase in your projected benefit obligation. So it's an expense caused by an increase in your projected benefit obligation. So again, remember, these actuaries are computing your service costs. This will be given to you if you need it. You don't need to calculate this piece of it. You also are going to have to pay some interest on this projected benefit obligation. So interest on your projected benefit obligation is an interest expense that accrues each year on this projected benefit obligation, and it's based on your interest rate called your settlement rate. And so to calculate this interest expense, you're going to take your settlement rate and you're going to multiply that by your projected benefit obligation, and that's going to give you the interest that is based on your projected benefit obligation that you have to pay. Also goes into these factors is your actual return on your plan assets. Remember, all of these contributions are going into a fund for when this employee retires. These monies are invested and they will get a return. So this is your interest and dividends that are earned within that fund. in that pension fund. So this is not only your interest and dividends, sometimes there's increases and decreases in the market value of these funds. That also goes into play on this return on plan assets. Another term that goes into this pension expense is your prior service costs. This occurs when a company provides benefits to employees for years of service before this date or amendment. So a lot of times there's amendments to these contracts that are laid out for these defined benefit plans. Employers make these amendments because they really will probably serve a future benefit for them over this change in the plan, but you still have to accumulate for those employees already in it. So again, prior service costs, this occurs when a company provides benefits for prior service due to an amendment in the plan. So because these plan amendments are granted with the expectation that the employer will realize some kind of benefit in the future, the cost of these prior services are providing retroactive benefits, and we're going to allocate the amortization of this to our pension expense, specifically to those remaining service years that are covered by these affected employees. So this prior service cost, that's related to the amendment that we just explained. So the prior service cost of providing these benefits these are retroactive benefits, is allocated to this pension expense. And again, we won't have to calculate what these prior service costs are or anything like that. We're just going to have to be able to apply them to our pension expense. And finally, we have gains or losses. These come into play for two reasons. One, it's the difference between the actual return and the expected return. That actual return on assets and expected return. Remember, these actuaries are calculating your obligation, and they include what they expect that rate of return to be. So we might have a difference there. And the second piece that could impact a gain or loss or cause a gain or loss is a change in the projected benefit obligation. Remember, these actuaries, they make a lot of assumptions. These are just estimates, and so some of the actual experience can differ from what we expect. So if there is a change in that projected benefit obligation, we would recognize that as a gain or loss. I know all of this sounds very complicated and complex. This is one of those things that once you realize what you have to do with this information, hopefully it will make a little bit more sense. And once you see, I think, what you're using this for, it's a little bit easier. So let's walk through one of these homework problems. In this homework problem, again, they're giving a lot of information. I kind of like separated out that information, make it easier to read so that I can find what I need when I need it. So the first thing we're going to do when we see all this information is one thing so we're going to have to do before we can even do a journal entry is figure out what is our pension expense, right? To get to that, we have to go through all those components, right? We listed here everything that goes into that pension expense or calculating that. So let's go through those, find those factors, and then we'll be able to calculate our pension expense. So there's a few things I'm going to be looking for to get that pension expense calculation. First thing I want to find is my service cost. So I'm going to read through this. I'm going to find where it talks about my service cost. That's in the first one here, and it was $56,000. Then also what goes into my pension expense is my interest on my projected benefit obligation. Remember when we talked about this, we said we're going to take our projected benefit obligation and we're going to times it by that settlement rate. So here they tell me my projected benefit obligation is $900,000 and I know my settlement rate is 9%. And that's going to equal $81,000. So my interest would be $81,000. Next thing I'm going to look for is my expected return on assets. Oh, I can't write today. Again, we're going to go through here. They're going to give us the amount, not anything you have to calculate. But again, we're trying to find that pension expense. So any positive return on asset is actually going to lower our pension expense. And finally, the last thing that's going to go into our pension expense is the amortization of our prior service cost. And again, they're just going to give that to us. I'm going to sum this whole thing up and realize that my pension expense is going to be $133,000. Now I can use this information to complete the journal entry that would be needed for this. I'm always going to debit my pension expense, which I just calculated. I know I'm going to kind of jump around here, so leave yourself some space. I have a cash value that I have to pay. I'm going to come up here and I'm going to look for that amount in all of the words that they give me. So they tell us the company's funding policy in number 2 here requires a contribution amounting to $154,000. So $145,000. Sorry. So I know the cash that I'm going to pay is $145,000. The prior service cost, that's going to fall into my other comprehensive income and loss. So I'm going to record that as part. Of $50,000 here. And then finally, the last piece of the puzzle that I have to record is going to be that pension asset or liability. And my debits have to equal my credits, so I know I can just plug this figure in to realize I need $62,000 added to that account. So when I come down and figure in my next step to figure out what my amount of my pension asset or liability is on my balance sheet, this is not that amount. This amount is going into that T account, adding or subtracting to that total balance. So this is just based on what is happening that 1 year. So let's take a look and see where some of these pieces are going to show up in your income statements and balance sheets. First thing that we're going to see on your income statement, couple of items that are going to show up there are under your expenses, you will show that pension expense. And we've already recorded it. We just are going to put it down in our income statement. Under that comprehensive income statement, in that section, that's where we're going to show that. So we're on the other comprehensive income section of your income statement. That's where we're going to show our amortization of that prior service cost. And that we're just bringing in to that area $50,000. And then finally on your balance sheet, we need to show a couple of different things here. We're going to show our pension liability and that accumulation of the other comprehensive income. And I didn't leave us a lot of space here, so I'm going to just draw a quick line right here. And let's look at first how much is going to be for that accumulated other comprehensive income. So first thing I'm going to look at is that stockholders' equity section. That's where you're going to see that section for your accumulated other comprehensive income. Now if we come up here into our information that's given, it's going to tell us that we have $400,000 right now accumulated. But remember, we are now showing that amortization of $50,000. So what's left is going to be $350,000. We take that $400,000 that was there and subtract what we amortized. Now let's look at this pension liability. This one is a little bit more involved because, so on this side, I'm going to look at that liability that we have to show. we're showing the pension liability underneath our liabilities on our balance sheet. But I want to show you how we're calculating that amount. We're going to compare our plan assets to our projected benefit obligation. Remember, that's how we calculate that liability or asset. And remember, we're not looking at what was coming in. Had they told us what we started with, we could adjust to get there. But what we want to do is compare our plan assets to our projected benefit obligation. So we'll start with our beginning balance. This is given to us up in the problem. $600,000 for our plan assets, $900,000 for our obligation. Some of the things that go into play here for our obligation are those that service cost, which was $56,000, and the interest, which was $81,000. Some of the numbers that we affect our plan assets are our return, which was $54,000, and our contribution, which was $145,000. I'm sorry I didn't leave a lot of space here to give you these figures, but when we add up our plan assets, you're gonna get $799, and when we add up our projected benefit obligation, you're gonna get $1037. So to find this liability, we're comparing these two numbers. And I'm going to take the $1,037,000, compare that to my plan assets of $799, subtract those two, and I get $238,000. So my liability is $238,000. It's a liability because my plan assets are lower than my projected benefit obligation. It's a lot to go through. You might want to take a pause, make sure you got all that down, maybe rewind, find yourself some more paper to write on, which is what I should have done, and go through that one more time. Might also be a time, if you did kind of grasp that, to take a pause again and try to do some of these problems on your own, and then come back and see if you got them right. So let's try and see again, how do these homework problems translate into multiple choice problems that you might see something similar on an exam. So this first one is giving you some of the information related to their defined benefit plan, and it's just asking you what amount is reported regarding pension liabilities or assets on the balance sheet for the year given. So remember, because we just went through this, it should be kind of fresh in your mind. We're comparing our plan assets to our projected benefit obligation. So I'm going to go ahead, subtract those two numbers, and it's going to equal $190,000. Now I have to determine, do I have a plan asset or a plan liability? This should say liability. I know it's not the right answer anyway, because this one is taking the difference between that, which we know we don't use. So the answer is $190,000, but do I have a liability or an asset? And this is where we're going to go ahead and compare our fair value to our projected benefit obligation. Our current plan assets do not have enough money to cover what we are obligated to pay in the future. Therefore, we have a liability. And again, how might this be presented in a word type problem? So again, if they have this defined benefit plan, we really focus on that defined benefit plan because it is a little bit more complex. So I wanted to give you a little bit more information to try on that one. So the question is, if I have a pension asset, what would that result from? So again, I know that based on looking at the problem I just did, and you can do this on your exam, if you know you got one right, you can always kind of look back to some of those questions because they might help you on other questions. This is an example of that. I know that I'm comparing my plan assets, the fair value of my plan assets, and I'm comparing it to my projected benefit obligation. So immediately I can cross out these two that relate to contributions and expenses. I know it's either A or B. If I have a plan asset, that means the fair value is going to be greater than my projected benefit obligation. Therefore, that answer is B. These problems might take a couple times before you get the hang of it. There's some that require a lot of worksheet work. So some of the scrolling is a little bit difficult. Give it a try. If you have questions, always email me. If you think you're spending a little too long on a problem, make sure you get some advice before moving forward and make sure you're making good use of your time.